This week, we're diving into the latest market movers you can't afford to miss. Rent-driven inflation is ticking up again, and it's affecting us all. Nvidia's H20 chips are making a comeback in China. What does this mean for tech? JPMorgan and Citi are racing into stablecoins. Who will come out on top? Trump has locked in a massive $20 billion buy-in in Indonesia. Let's break that down. And don't miss our reveal on how FX swings can make or break your foreign returns. Stay tuned till the end to catch every market mover this week.
Hi, Deep Thinkers. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here in Krakow, Poland, just traveled from Warsaw yesterday, really enjoying it here. And Rob Farian is on vacation this week, so I'm excited to present our guest host. Mark Rosano is the founder of C6. He is one of the best energy experts, and in particular, alternative energy experts. I know his work in hydropower, pardon me, is some of the best I've seen, but he's also great on hydrocarbons and other traditional forms of energy. Mark, thanks so much for joining us. How's your week been?
I appreciate it. Thanks for having me. It's nice to step into to some difficult shoes to fill. Things are going well. Just looking at the markets, getting a sense of where rates are. Always starting with Japan and the U.S. to see what kind of fun are we going to be in for this week.
I want to give Mark credit. He and I did a show with what was the New York Alternative Investment Roundtable,
Yep.
talking about the issues that Japan was facing. This was in October of 2022. We were both early on it, but the two of us, they told us you've got 45 minutes, and an hour and 15 minutes later, people were still asking questions. I think that was a great show. It's still up on YouTube and on LinkedIn, so it's findable.
Absolutely. I mean, to your point, we kind of outlined exactly what was going to happen or the unwind of the QE infinity. And it's just interesting to see how things are taking pass. And I think that really leads into one of our first topics, which is the CPI. So we had the CPI. There's always been a lot of talk that tariffs were going to be this huge increase. But you're starting to see some waffling. You're starting to see CPI creep up. Powell's still going to hold the course. What are you thinking in terms of what happens, what has happened, and what's going to happen going forward?
Thanks, Mark. So this is one where DKI has been early and right. Just a couple of months ago on Liberation Day, the market completely freaked out. The FinX community or FinTwit community, depending on your view of time, went completely hysterical. Oh no, tariffs are going to destroy the economy. We're going to have horrible inflation. It's coming right away. But that's not what happened. And I came out early and said this may not be the disaster everybody's expecting. Tariffs typically don't lead to inflation. They lead to an increase in domestic production and shifting to lower cost alternatives. We cited all kinds of research on that. And, so far we've been right on this. And one thing I think is really interesting is all the hysterical fiat economists, and I say that with more sarcasm than I normally use, they're now saying, well, yeah, we're still going to have a disaster. We're still going to have inflation, but we won't see it until like October or November. Okay, well, but in April, they were saying it's imminent, and it simply hasn't happened. Going to last week's CPI, that's the Consumer Price Index. When people talk about inflation, that's typically the number that they look at. The overall increase was 2.7%. That was up just a little bit from May and 0.1% above expectations. The core CPI, that's the number that excludes food and energy because nobody needs either one of those things, was up 2.9% versus last year. God, I'm not normally so snarky, but it's just really hard with stuff like this. Anyway, the yearly core number was 0.1% above last month's 2.8%, in line with expectations. Look, these numbers are too high, but they've been too high for years at this point. There's really been no evidence that tariffs are taking hold or creating any kind of lasting inflation problem. The main reason for the increase in the CPI was shelter. That's the fancy finance word for housing. That's been on an upward trend for years and really isn't affected by any kind of tariff concerns. On the consumer side, we're seeing increasing signs of consumer credit stress. This is not a surprise to anybody who watches this show on a weekly basis. We've got buy now, pay later loans. That's a $1 trillion plus that's now being reported to credit scoring agencies. Many Americans are seeing their FICO credit scores fall as a result of that. Credit card delinquencies are increasing. Auto loan delinquencies are increasing. And those with student loans are now responsible, again, for making payments. That's leading to further decreases in credit quality for millions of people. Mark, one thing that really surprises me on this one is I keep seeing reports from people who have student loans complaining that now they have to reduce discretionary spending because the multi-year break they've had from payments has expired. I think it's really interesting that so many people who knew that they had debt chose to spend the temporary break from payment requirements rather than save or invest the money, in which case they'd be much better off. I think our culture needs to have a change in our relationship with spending and debt. That change, by the way, should start in Congress. We're not just picking on the student loan people. It should start at the very highest levels of the country. Concluding on this one, I agree with current consensus. The Fed's going to keep rates unchanged at the next meeting. The difficulty they'll have is a lower overnight rate is going to lead to higher 10-year rates as the bond market prices in higher expected future inflation. So I don't, President Trump and Chairman Powell can fight all they want. I don't think there's a whole lot that Powell can do to resolve this. So that's my view on it. I think the CPI really no impact and the Fed's going to pause. What's your view on this?
So before I go into my view, I have a question for you. So you talked about 2.9%. I know that what I'm spending monthly is by no means 2.9%. Are you seeing something similar? What is the disconnect between what we're seeing on a monthly basis and what is actually being reported?
Yeah, I've been talking about how the CPI has been horribly inaccurate for about 4 years now. The shelter increases are not being captured. There's a huge disconnect between the rental market and the rental market and the purchase market. More importantly, the place where I see a huge disconnect is in food. The Bureau of Labor Statistics, which compiles the CPI, they've been saying that food inflation is somewhere in the 1 to 3% range for years now. Every time I see that, I write the same thing and I challenge everybody, if your grocery bills, if your food bills, if your restaurant bills are up only 2 or 3% in the last year, I want to hear from you. No, exactly nobody has taken me up on that. We've seen reports of just, 20 people spending 20% or more. I don't believe the numbers. I don't think anybody else does either.
So Powell's going to pause. I 100% agree with you on that. But if he didn't, and for some reason he cuts, would it actually matter?
No. The reason I think it wouldn't matter, and this is something that people don't understand, and unfortunately, as much as I think President Trump has made some really good economic decisions, I'm not sure he fully understands this either. The Federal Reserve only controls the Fed funds rate. That is the overnight rate. That really only affects the big banks, right? The bond market determines the rest of the yield curve. And so let's go back to last September, where over the course of 2 or 3 months, the Fed cut by 100 basis points. Again, that's just fancy finance speak for they cut by 1%. And we saw an increase in the yield on the 10-year of 1%. So basically, they went from a negative slope on the yield curve and an inverted yield curve where you had high short-term rates and low long-term rates to a normal yield curve where you have low short-term rates and high long-term rates. But that wasn't how they wanted it to happen, right? They wanted the yield on the 10-year to come down. The bond market pricing in higher expected future inflation basically said, yeah, we don't believe you. You can cut all you want, but the cost of capital is the cost of capital. And that's the thing I think a lot of people don't understand. The Federal Reserve does not control anything longer than the overnight rate, and the market doesn't want, they talk about wanting lower rates, but I don't think they really want to see it. What do you think? What do you think happens if they cut in at the next meeting? What do you think happens to the 10-year yield?
I think it spikes. I've been saying from the beginning that when you look at Volcker did a lot of hard work to get in front of inflation by gunning rates as high as he could and then bringing them down slowly because he wanted to give the view or the perspective that, hey, I control this. And then a lot of the Fed managers and Fed chairmen after that have essentially benefited from that hard work, but now that is gone. That band-aid has been ripped off, and I think people are finally coming to terms. And by people, I mean those that aren't boomers, not to pick on the boomers here, but there's a huge view because that's where I fight the most. They're like, Powell needs to cut rates. He's being political. I need my prices to come down. And it's like, guys, that's not how that works, actually. There is going to be a big disconnect. And I think people forget about what happened with that cut in September, how that spiked the long duration, and then there's this view that it's like, oh well, don't worry, Bassett can go from just selling long duration debt to just selling short duration debt. It's like, okay, there is some truth in that in terms of volume, but even that has a maximum. And there's a view that isn't going to be the case, and you're just going to see a rebalancing in terms of where the debt is issued. But you're still going to see inflation. You're still going to see deficit spending, and it's only going to make the clearing price, or because price and yield are inverse, as the price goes down because people are like, I'm not bidding on this, it means that the clearing price goes at the yield in order to get people to buy goes up. And that is where you're going to see that biggest cost because we are firmly in a debt spiral. The M2 shows that in terms of your comments about where inflation is going. When you look at the money supply, it continues to grow. So you're already seeing some sort of QE in there. Tariffs, when you look at who's paying for them, right now they're coming from the producers. And and if you really want to see where tariff pricing is going to hit, you have to look at PPI, that producer price index, because it's going to show you what are our what are our import prices. If those are exploding, if those import prices are just absolutely gunning higher, that's tariff. That's a cost. But right now they've been very stable, and it's because the producers from a foreign entity are willing to backstop it, and they're willing to compete to still get into the U.S. markets. And then when you look at CPI, I have to laugh because as somebody who has to buy, obviously health insurance, my health insurance is now more expensive than both my mortgage and my homeowner's insurance. But yet when you look at where healthcare sits in that grand scheme of things, it's still well below 25%. And I love when you start looking at why CPI missed. It's because used cars and airline tickets went down. It's like, well, I don't eat airline tickets. I mean, maybe I can buy a ticket to get on the plane to eat their food. But it's like, guys, like, how is this balanced? So when you think of the number, I always think it's just it's a fake number that is used to try to direct whatever policy they want. But even the fake numbers that are still going higher because of the pressure that we're seeing.
Yeah, a couple of years ago, they were showing that health insurance costs were down. That is clearly not true. They've more than doubled in the last few years. I mean, just so many of these expenses are way up for people. A couple of extra points I would make on this, besides the fact that healthcare is criminally understated in the CPI, among some other things. Like, by the way, my homeowner's insurance has doubled in the last few years, right? And you can't go without that. And that is not being reflected. Separately from that, for all the people saying, well, we need Powell to lower rates. Again, I agree with Mark that if Powell lowers the Fed funds rate, we see an increase in the 10-year. That's how mortgage rates are priced, right? So what I'm telling you is if Powell cuts, I think we're going to see an increase in mortgage rates. And that's going to be really rough for people. Anybody who has to refinance, that's going to create hardship for a lot of people. That's not the direction we want to see things going. The other thing is, Mark makes a great point on economic history when he was talking about Volcker jacking up rates as high as he could. He's referring to Paul Volcker, who was the former chairman of the Federal Reserve. This is back in the late 70s, early 80s. And that's when we had the horrible stagflation of that time, where the misery index, was defined as inflation plus the unemployment rate. It was over 20%. And what Volcker did was he took the Fed funds rate to right around 20%. And then, as Mark said, he lowered it very slowly. The reason that Powell can't do that now is because we now have $37 trillion of debt. Our debt to GDP number is completely different. We are not Japan, but we've got the same problem, right? Which is the central bank really does need to raise rates, but doing so blows out the budget. The only thing you can do in that moment, if you're the US government, is to print more dollars to pay the difference, and wait, that leads to more inflation. This is why I say the Fed is trapped. So Volcker had flexibility back in the late 70s and early 80s that current Chairman Powell does not have. So that's your economic history lesson for the day, doing all we can to try to keep it interesting.
Well, and the last point that I love on the history lesson, and again, not to get political, but everyone's like, "Oh, Trump, this is the first time a president has ever gone after the person." I'm like,
Not
well,
true.
Lyndon Johnson threw the chairman against the wall.
Burns.
Truman threatened to launch the Fed chairman. I believe it was off of a warship. Everyone as early as recent as Obama said that Bernanke has stayed too long and is out of touch. So again, there's a lot of things where there's always been conflict between these two entities, and it's unlikely to resolve anytime soon because one wants to spend and the other, in theory, should want some sort of economic fortitude in terms of, ensuring that we will exist tomorrow versus spend our way out of everything.
Yeah, yet again, President Trump gets the blame for mean words when you're right. Lyndon Johnson actually picked up Federal Reserve Chairman Arthur Burns and slammed him into a wall. Something that I'm pretty sure President Trump will not attempt with Chairman Powell.
Yes. So now moving on, when you look at something that happened with Nvidia, so the CEO, Jensen Huang, meets with President Trump, and all of a sudden they're allowed to sell the H20 chips to China, which, as we all know, was a huge concern, giving them this strength, giving them this they're now going to compete against us. Was this the right move?
So this is a really tough one. It's one of the more complicated issues we've tried to cover on the five things. Let's talk about the different aspects of it, and I'll get to my conclusion. I think it was the right move, but it's a really tough call. Let's try to unravel this. So what happened was the previous White House, the previous administration, went to their experts and they said, okay, well, we don't want China to have access to the best chips to design their own AI systems. We want them to have a crippled version. What makes the chip special? And somebody said, well, it's the throughput rate. And so the previous administration said, okay, well, Nvidia, as long as you limit the throughput rate, we'll let you sell to China. Nvidia got a little too clever and they technically complied with the regulations, but the H20 chip, which was the supposedly crippled chip, ended up with technical performance that was really close to their high end. So they technically complied with the rules, but effectively circumvented it. In addition to that, China was getting access to NVIDIA's best chips through just buying them through other countries. I think at one point we were reading that there were places in Vietnam that were buying more chips than they had electrical capacity. That basically, if they shut down all the lights and air conditioners and every electrical system in the area, they didn't have enough electrical power to power that number of chips. Those got put on planes and sent to China. China was also making use of virtual capacity where they were just buying time on the high-end chips in other countries. So all of these regulations were ineffective in being circumvented. Now, on the other side of that, China said, hey, US, you're not going to sell us the best NVIDIA chips. Guess what? You can't have rare earth elements, and those are really important for our electric vehicles, for battery systems, for solar power, for all kinds of alternative energy that I'm sure Mark will comment on shortly. They're also important for weapons systems. So basically, the US really needed those rare earths. President Trump came to an agreement with China and Jensen Huang, who's the CEO of NVIDIA, and said, okay, here's the deal. NVIDIA, you can sell the H20 to China. NVIDIA was happy. China was happy. China said, okay, US, we're going to allow you to buy these rare earth elements that you need for your systems. And sales last month, or sorry, not last month, last week, skyrocketed. They were up something like 5 or 6x where they'd been the prior month. And so our people were happy. And so this was a deal that needed to be made because China had undue influence. They could basically say, if you don't want to sell us these, you need our rare earth elements. We have influence. So here's my key point in this. We've talked about this before. I understand the desire of the last two presidential administrations to say, hey, China, we don't want to sell you our best chips. But remember that when you do that, you encourage and incentivize the Chinese to develop their own chips, their own competing capacity. Once they do that, and yeah, it'll take a few years. It's going to take a little while. They're not going to catch up to Nvidia in the next 24 months. But once they do that, they don't need us. They don't need our product, and we lose that influence. And so for people who want to be critical of the deal, and I understand why you would want to be critical of the deal, this is not clean. Geopolitics are never clean. You never get an exact perfect answer. You don't get the outcome you want. You get the outcome you negotiate, right? And so for those of you who are against this, I understand your point of view. I value your point of view. But just remember something. The reason China got the concession they wanted from the United States this time around was because they had something we needed, rare earth elements. Well, if we don't sell China high-end Nvidia chips, in a few years, we won't have something that they need. And when that happens, where's our influence? Where's our ability to push through a solution that we want? We will lose that negotiating capacity and be at their mercy. And that's not somewhere I want us to be. So was this clean? Was it perfect? No. But in the end, I think it was the right thing to do. For those of you who disagree with me, I'm interested in your opinion. Feel free to put it in the comments and let us know the reason. Just use the word because and tell us why you disagree, why you wouldn't have made the deal, or how you would have structured it. I will respond to any of that. Mark, what's your view? I know you've done a ton in the EV space and the alternative energy space. You have to have thoughts on this.
So it's interesting because when you look at the, let's just call it the brain of a situation of the computer, I think people give China a lot of credit, and credit that I don't think they really deserve. And I use the example in this specific one of Ferrari. If you give someone in China the Ferrari engine, are they going to build a Ferrari? And the answer is no. And because there's a lot of other things that are surrounding that engine. How is the input? How is the output? How is the chassis? How's the roll? How's the suspension? And a computer is no different. And I think sometimes everyone just thinks, oh, they got the fastest chip, therefore. It's like, well, no, there's other ancillary pieces behind this that are so important when you think about the different pieces. Like when you look at they found AI, they are doing it at less power. They're not. Without open AI, their systems don't exist because they essentially built their systems off of open AI, and without a continuous growth, theirs will never change. But then as soon as people recognized it, you saw outages, you saw shortages, you saw power issues. So there's a lot of things that really surround this. And now, while to Gary's point, there's always that uncertainty. Realistically, a good negotiation, nobody's happy because everyone's going to give up something they don't want to give up, because that preserves, to Gary's great point, that preserves your leverage. And that's the whole piece, is how do I walk away getting what I want, giving up something I didn't really want to, but I'm always going to be able to hold that leverage, or I'm going to be able to carry that leverage to the next negotiation or to the next time that we meet in a means where, okay, how do I get something that I want from you? And I think when realistically, you're also getting feedback. And I think people don't appreciate that, when you build a car, you test drive it, and you have experts that are test driving and saying, I felt some roll going into turn 3, can we look at this? When you have this chip installed, you're getting feedback. You're then going to build a better chip in the US. You're going to build a better processing capacity in the US. And that's going to keep you ahead of your competition, because to Gary's point, if we make them do something on their own, not to say I think they can, but you're going to push that well, that becomes a different issue. Now, at the other side, and then this is the final point, we also want to keep the populace on our side. I don't think there's appreciation that there is a huge divide within the country between the CCP and other. And
Yeah.
the CCP is only 100 million, 110 million, where you're talking about a 1.3 billion dollar entity,
Person.
and there is a very big point where you want to make sure that you stay on the right side of get what you want, which is those rare earths because we need them. They're a structural, military, political, and other importance while keeping those individuals happy. And I think that that's a balance that is really hard to walk. And I think this deal structured in such a way did that.
Yeah, I think those are all really good points, Mark. One thing that I think is really worth emphasizing is when you were talking about DeepSeek, that was built on the back of US models.
Mm.
And one of the things that people I think don't have a full appreciation for is how quickly these models change. Just 6 months in the AI space is like a decade in other spaces. You get products that are completely different. The capacity of these models changes unbelievably fast. And if you're not completely up on the latest everything, you are effectively years behind. So that complicates things, and that's why China needs access to our best our best products. And without it, it's not like they have superhuman capacity. But if they don't depend on us for something, they're going to develop it. And I think your Ferrari example is a really good one. For me, the essence of thinking strategically, it boils down to asking yourself one simple question: what happens next? If I do this, what happens next? And I'll tell you on a personal level, I just had a negotiation with somebody where this person thought they pushed me into a corner. They thought they pushed for a solution that was advantageous to them and disadvantageous to me. But they weren't thinking long term, and it won't work out well for them long term. They'll get what they want today, and that's fine. But the simple act of not thinking, wait a minute, if I do this, what happens next? It's just, to me, that is the essence of strategic thinking. And I think that's something that a lot of people were missing. And I think it's something that President Trump and Jensen Huang got right here. And you're right, we have a problem with the 110 million person. The CCP, for people who aren't familiar with geopolitics, is the Chinese Communist Party. But there are more than a billion other Chinese people who do not need to be the enemies of the United States.
So when you look at thinking long term, we talked about CPI, we talked about, some of the different back and forth with China. Let's turn to the Genius Act. And for those that don't know, it's the guide, and I had to Google this because I don't know what the acronym is, but Guiding and Establishing National Innovation for U.S. Stablecoins Act. I know that you've been on the Bitcoin wagon for a long time, and you've been very right in terms of direction and whatnot. But is this something that makes sense when you think about regulating stablecoin, trying to take that cryptocurrency, but it's still pegged, this is my problem, it's still pegged to the dollar and treasuries. So are you just now giving another avenue that you can just sell treasuries to because they have to buy it in order to create this stability through this act? Or am I completely off base? This is a great idea, and this is where we need to focus.
I think it's both. I think it's both. Let's talk about it. So as Mark talked about, the Genius Act is it's about to happen. It's passed the House, and it's going to pass, and I believe the president is going to sign it. He's been a huge supporter of crypto and Bitcoin in his second administration.
Mhm.
And so what we just saw last week is JPMorgan and Citibank are actually saying we're going to issue stable coins. Let's talk about what this is and how to think about it and unravel some of it. We'll dive in on this. So first of all, what a stable coin is, it's a coin that exists basically on the blockchain backed by dollars. And so, you could have a dollar in your bank account, or you could have a stable coin that's worth a dollar. But here's the key point, and this is something that's really important with the legislation. Banks are fractional reserve lending institutions. Okay, that is just a fancy finance way of saying that for every dollar of deposits that a bank takes in, they may be making 5 or 7 or 8 or $10 of loans, right? So they have loans that are greatly in excess of their deposits. And what that means is that if everybody who deposited money in their banks went to the bank at the same time and said, we'd like our money back, please give us, it's a demand deposit. I demand that you return the money, right? That's actually what the term means. If you've ever seen a demand account, the bank would be unable to pay you. And they'd have to start selling assets at fire sale prices. And if we just go back a couple of years, that was what happened with First Republic and Silicon Valley and one or two other banks. So that's the issue with fractional reserve lending. Now, stable coins are going to be by law, they have to be 100% backed by treasuries or cash of 90 days in duration or shorter. And so what that means is if everybody who had a stable coin went to the stablecoin issuer and said, give me dollars in exchange for the stable coins, they would be able to pay everybody about 100%. So they are fully reserved and fully backed. In many ways, a stable coin can be considered an electronic version of cash that is more secure than a bank account. Now, JPMorgan and Citi are smart to get involved here. Mark was making the point correctly that, wait a minute, if we're going to have billions or even trillions of dollars of stable coins and they have to be 100% reserved, doesn't that mean there's going to be huge demand for treasuries? And I believe that's the case, right? By passing this act, guess what? It's given Treasury Secretary Bessent an enormous tailwind because there's going to be, we've talked about this before, he has to issue, what is it, $7 trillion of treasuries this year? It's some insane number like that. Well, guess what? This passing will create massive demand. Now, it's not going to create demand for 10-year treasuries or 20 years or even 5 years. It's going to be 90 days or less, but it still is going to help him issue more of these treasuries. Now, the thing that I really want to point out is while this can be very good for the US Treasury and help out our Treasury Secretary, the stable coins are going to be a huge blessing for the American people and a huge threat to the banks. And the reason is this. It's because banks make their money, much of their money, by extracting fees from customers and from earning interest by delaying routine transactions like wire transfers. If any of you ever, you've paid for a wire transfer, you pay the bank $25 or $50, well, that's profit for them. And then they say, yeah, we didn't get to it today, but don't worry, your money will be in the other account by 4 o'clock tomorrow. And you're thinking, wait, I just paid you $25 to transfer this electronically. Why does it take you more than 30 seconds? And the answer is, well, we don't know. Just because, and they're earning interest on that. Well, the deal with stablecoins, and this is why they're such a threat to the banks, is stablecoins will enable you to make instant fee-free transfers. So think about this right now. Let's say, Mark, I wanted to invest in your fund C6, right? And for people who are interested, you should check him out at C6. But if I want to invest, Mark, what do I have to do? I have to go to the bank and I have to initiate a wire and I got to pay fees and it's going to take a little while. And by the way, because it's going to be a large investment, they may delay it by a couple of days and earn interest on it and then say, wait, what do you need the money for? And my answer is, it's none of your business. I want to invest with Mark. And well, what's Mark doing? Again, it's none of your business. Great investments. So there's all of this nonsense and the banks delay and they make money off of this. With stable coins, again, instant no fee transfers of funds. I could just send Mark that money and he'd receive it in stable coins. They're 100% back. So remember something, as consumers get more comfortable using this new technology, this is going to be a threatening new competitor to traditional banks. And your fractional reserve lending bank can't say they're 100% reserved. By the way, for what it's worth, DKI has a position in the portfolio to take advantage of this trend. If you're interested in that, you're welcome to go to Deep Knowledge Investing, click subscribe now. That is something that's only for premium paid subscribers. But, we are positioned to make money from this trend. And, I think it's something that's going to be worth following. Mark, do you have any experience in the stablecoin area?
So one of the things that was interesting, and I brought it up at the very beginning, was Bessett's ability to sell near-term treasuries and the near-term shift. And I do think that this opens up some opportunity. to your point, and I think it's started to get more press over the last 5 years, and they disguise it under know your client. And realistically, it's a means of delay. It's, well, why do you need this $5,000? I'm the treasurer for our local Williston Park Little League, and I had to take money out when we were having a fundraiser just because we needed cash for to make donations, to make cash for raffles and the like. And I thought they were going to ask for hair samples and blood. And it's like, guys, like this is a nonprofit. Like, I don't know what you think I'm going to do with this money. I need it to. And then when I had to bring it back, and you'll be shocked to know it went very well. We had a few additional $2,000 in actual cash. You would have thought that I essentially was a crack dealer, and I just sold a kilo of coke, and this is why I have this money. And I think that the disgust is real, and people are open to alternatives. Now, there are money market accounts. There's technically your checking account, which technically should be available. But when your checking account, which should be available at time, is not, savings is one thing. Savings, they have a right to, it's in the contract, they can move it around. Money markets is supposed to be overnight. And checking account is supposed to be, to your point, demand. I want this right now because it's
Right.
in my account. And when they start waffling between the two, which is again the Glass-Steagall Act, it should have never gone away. It should have been the first thing that came back into existence post '08. And the Glass-Steagall Act separated banking and investment banking. They're very different because, in my opinion, and I believe Gary and I we've spoken about this, an investment banker should never have access to grandma's savings ever. That whoever thought that was a great idea should obviously be fired. And luckily, they are either dead or fired at this point in time. But there's no willingness to bring them, to separate them again, because it would create such an upheaval, because there's so much collateral that has been spoken for and backed up. And now we're trying to figure out, well, how do we establish some sort of security? And that's where I think the stable coin side comes through. I do think it's a bit of a manipulation to open up a new market for short-term treasuries or short-term paper just to give it a home. But it's coming out of a need because people are frustrated with the way the banking system operates.
Yeah, and with good reason on that. And where Mark is talking about not allowing investment bankers or effectively hedge funds to have access to grandma's savings, right? This is a key point that he's making because when people have talked about socializing losses, what always happens with the banks is they make money by taking risk. And that's great. So good for them, good for their shareholders. But then when they lose money by taking risk, they get bailed out because they're systematically important. And I proposed a solution to this, I think, in our episode of the Five Things just 2 weeks ago, where I said what should happen at this point is the government should go to these big, too big to fail, systematically important banks and tell them, we want to be clear right now that there will not be another bailout. You're welcome to take whatever risk you want, but when it happens, we want you to know that your shareholders are going to be zeroed out. They're going to get their stock is going to be worth zero. You're going to be fired. You're going to lose your job. Your bank is going to be closed, and all of your stock options are going to be worth zero. So you think long and hard about how much risk you want to take. Do what you want, but we're not going to bail you out again. Now, that's a fever dream. It will never happen, but that's my proposed solution to this particular problem, right? Let them take whatever risk they want, but make it clear that the taxpayers, that ordinary American citizens are not going to bail them out. And then, by the way, Mark, grandma will be in a position where she can say, do I want stable coins that are 100% backed? Do I want to go to my local savings and loan, which isn't acting like a hedge fund or a local community bank? Or do I want to bank with one of the big banks, which, may be a hedge fund on steroids with more leverage than even their bond department knows about?
And I think that's so important when you look at the different options because, one of the things that I love is when they did the stress tests, nobody ever questioned, could rates go up? And it's like, were you really that? Did you really believe that the market had no restitution against you, that there wasn't going to be a push? And that created the first thing, because my running joke is if you want to flesh out corruption and evil doings, raise rates. And rates will, and that really kind of paves a way. But again, to your point on all of these individuals, they will get left in the lurch because of the bad actors of things that they don't even appreciate or know. And that becomes a huge problem.
Yeah.
But when we go forward and we start looking at ways to fix things, President Trump has signed or is looking at landing that deal with Indonesia. Gary, I believe you and I spoke about this where we said my comment was, look, these deals are going to be structured with either India or Vietnam, but the dark horse in the race is Indonesia because they have a lot to gain and we have a lot to gain because they control this very important thing when you look at Indonesia, Malaysia, and the like of the Strait of Malacca, when we think about China and the strategic nature behind it. So when you look at the Indonesia deal, is it a good deal? Is it one that is going to be the model going forward for some of these other nations?
I think it is. And personally, I love this deal. I think it's great for the United States. It's going to work out well for Indonesia. Let's talk about some of the details here. So, President Trump and Indonesia's president reached terms on a new tariff deal. This lowers President Trump's original Liberation Day April tariff rate of 32% to 19%. Indonesia's rate on US imports is zero. Now, for people saying, wait, that's not fair, fair enough, it may not be, but there's a huge trade imbalance here, and this is trying to even it out. The deal also includes an Indonesian agreement to purchase $15 billion of U.S. energy products, $4.5 billion of American farm products, and 50 Boeing jets, including several 777s. I have no idea how many billions of dollars that is, but it is a gigantic number. Indonesia is also a major exporter of resources like copper, which we need. And that opens an avenue for the U.S. to access copper from Southeast Asia. So the whole point of all this deal is on our end, it's going to reduce the $18 billion trade deficit the U.S. has with Indonesia. Indonesia avoids the 32% tariff disaster that they saw coming. And that part, that works for everybody. Now, one thing I want to read here. Mark, this was written by one of our interns. I did not edit it. I'm amazed with some of these 19-year-old kids, right? It is genius. Just for clarity, I didn't write this, but a 19-year-old wrote it. I thought it was genius. They wrote, this deal is not about trade. It's about President Trump turning the American consumer base into a monetized asset. Indonesia agreed to spend billions to dodge a 32% tariff. There's no enforcement or timeline, only a promise in exchange for market access. President Trump did not lower tariffs. He sold the privilege of being tariffed less. And I think that is, I mean, this is a 19, our interns are amazing. That was written by one of them. I think it's a fantastic way to think about it. One of the things that we've praised President Trump for many times on this show is the way he's acted as an advocate for U.S. industries. This man has flown all over the world making deals for foreign countries to buy huge amounts of U.S. product. He had a Middle Eastern tour earlier this year. He came back with trillions of dollars of purchase orders. I think that's phenomenal. Why aren't more of our politicians acting as advocates for our own companies, for our own industries, for our own workers? I like that. I think we can expect more buy your way in deals ahead. A lot of people in the media are making taco jokes. It's the Trump always chickens out jokes, but they should be more focused on the massive purchase orders the president keeps bringing in for U.S. companies. I like this deal. I think it's good for the U.S. I think Indonesia's relieved that they don't have a 32% tariff to deal with. And I think we're going to see more deals like this. This is going to be the model that other countries are going to follow for access to the U.S. market. What's your view on this?
Well, it's interesting because you talk about how, well, we have zero, they have to pay. And it's like, isn't that unfair? And the one thing I want to point out is the LCR, and that's the local content requirement.
Yeah.
Because when people were looking at what Trump was doing, which was, it seemed a little less structured than it should have been. But when you look at what he was doing, everyone's like, well, the tariffs aren't that bad. It's like, but what is the local content requirement? What is the trade related investment measure, which is also, or trim? And there's different ways to create restrictions without just saying you pay a tariff. And the LCR, which is the local content requirement, every country has it to a degree where the government has to procure something that is 25% locally created, or an electronic, or a car, or, a shirt, or anything of that nature. You have to have a certain amount built in country. Now, if you look, and one of the things, I believe it's now not these shoes, when you look at some of the things, we have a lot of manufacturing that has moved to Indonesia, it's moved to Malaysia, Vietnam. And so we are already meeting that local content requirement, but we're giving that production, we're protecting that production to stay there, providing those jobs, providing that opportunity, but we need something in return because we're meeting that local content requirement by not manufacturing the US, manufacturing in Indonesia, but then we have to recover some of that coming home. But to the point that I think was brought up by that very intelligent 19-year-old, is we are a source. Like if you think about what China was selling in 2010, 2011, 2012, it's, oh, do a deal with us and you gain volume. Give up margin, we'll give you volume. And it never materialized. And what do we know about the US? And we've talked about it. It's that we need a different culture of spending, which was really created during the 70s and 80s and well into the 90s of just don't worry, act irrational, and we'll spend money. That still holds the course at the moment. So you're getting access to that huge market, and that market that really wants some of the quality, because Southeast Asia does create some better quality than some of the things that have come from China. You do have some of that opportunity, and I do think that this is a friendly framework because, and then if you look, Jen, you can Google China building their brand new dam, which is in Tibet. There's a lot of fear when you look at coming into Southeast Asia, because some people will say, oh, they signed the ASEAN deal, the ASEAN deal with China. It's like, well, there's still fear there. There's still, what is China going to do? Why are they fishing in our neck of the woods? Why are they damming up water that's coming down into these nations? And obviously, Indonesia is a separate part of that. But when you look at where things are, there's a lot of concern in terms of where China sits versus where India into the Middle East corridor, into Israel, into Europe in the West. That seems like a better route, but you want to play, two sides against the middle. And I think this is an important move to say to China, hey, you keep doing this, we're going over here, and we will get the volume we want. We will get the access to the markets that we crave, because this is a market that we know is established and is going to continue to spend as such.
Mark, I think you make a fantastic point about geopolitics, which again are always complicated. Go back to, the previous topic where we were talking about strategic thinking. It's simply the act of thinking what happens next. And China has been behaving in increasingly aggressive ways in the Pacific. They've been building islands. They've been claiming territorial waters that had never belonged to them. They're encroaching on multiple countries, including the Philippines, and laying siege to actually one of the Philippines islands. And those countries do not want to be at China's mercy. And if the U.S. disengages from that part of the world, which we're not doing, that puts those countries at China's mercy and leaves us at odds with that whole part of the world. But if, as you point out, President Trump and the United States can bring the U.S. closer to some of those trading partners, it alleviates some of the pressure that they're feeling with China and puts us in a position to have better relations with countries that are natural adversaries of China. And that's not a bad place to be. And by the way, for people who are saying, oh, no, no, it doesn't work that way, take a look at what China is doing in Mexico, and particularly in South America, right? China is doing, and Central America as well. China is doing everything they can to establish a foothold pretty much on our southern border and in our hemisphere, and to exert undue influence on our natural trading partners. If we don't do the same, China will have an increasing amount of power and control. We don't need to give that up. We just need to do advantageous deals with China's local competitors. And I think the way you're talking about it is a really strategic way of thinking about these issues.
And to your point, China has gone after those water. You have the Three Gorges Dam, you have the new one, which is going to take. And I love how some people are like, well, it's only 30% of India and Bangladesh's water. It's like, 30% is a big number when you think about the way water flows. And you've seen a lot of those issues when you look into Vietnam and to others, and everyone's looking at what is the way out. What is the alternative?
Right.
And I think stepping up and providing that alternative is paramount, especially with someone that is blessed with copper and others, because we also need to get strategic, and by us I mean the US, in terms of where are we investing in mines, where are we investing in not only just the mines themselves but the refinement. You can't just take copper out of the ground and throw it in a wire. You have to process it, you have to smelt it, you have to do different things to it. And for the environmentalists here, it's not the cleanest. It's gotten better, but do we want that here, or do we want to pay for someone else to do it and then ship in the final product? So there's a lot of this means of, let's look at the supply chain and be smart about where we're investing and the deals that we're doing to ensure the whole supply chain is protected. And we do have this very important thing known as our naval assets that help us, say, hey, if you come along with us, we have that protection, we have that support that we can provide to keep those trade lanes open.
Yeah, it's a great point. I think it's a really smart way to think about it. And when people talk about these trade deals, they rarely talk about the kinds of influence you're talking about. But I guarantee you, it's something that people in Congress are thinking about or should be thinking about.
And it's fun because we talk about naval assets, but the other component that we need to look at is currencies, the US dollar and the like. And so one of the last topic here is the impact of currency moves on returns, people's portfolios. Selfishly speaking, I was going to get a PhD in currencies. So it was going to be currencies, rates, and commodities and how they intertwine and interlink, because a currency move is going to impact rates, is going to impact commodities, is going to shift the way things, what debt you're in, like what debt am I going to issue? Am I going to get access to new markets? Speaking of in the early 2010s, mid 2010s, when we took our rates to zero, people realized, or countries realized, hey, if I issue in dollar denominated debt, I get access to pension funds and 401ks and insurance companies because they don't have to worry about hedging. So when you look at this, how are these currencies going to impact returns? And is there a way people can protect themselves against some of these foreign exposures if they want to get involved in some of these great moves that are happening abroad?
So there is, but it's complicated. Let's start by talking about what the real issue is. So, there are all kinds of ways to invest. And as primarily US investors, most of us focus on US based stocks. And the truth is, the United States has the largest, most liquid capital markets in the world. And so it's easy to find attractive stocks at home. But there are times you might be interested in growth in another country, or particular stocks in another country, or maybe an ETF, an exchange traded fund that is a country index. And so, while that can create portfolio diversification and potentially put you in a position to benefit from faster growing markets or a faster growing company, it's important to note that those international returns are dependent not only on the performance of the individual company, but also on changes in the exchange rate of that company's currency. So exchange rates will move based on supply and demand, changes in interest rates, market interference by central banks. We've seen a lot of that. But it's really important to note that a change in the foreign exchange rate can move the positive returns of an investment in a foreign company negative. It can also go in the other direction. So the way to think about it is, if you invest internationally, you could win or lose in two different ways. There's the performance of the investment that you make, and then the performance of the currency. So, we saw that just a couple years ago in Japan, a topic Mark and I have discussed at great length. And the Nikkei index, which is like the Japanese version of the S&P 500, just, an index that's supposed to capture Japanese industrial stock performance. The Nikkei was up a huge amount. And people were saying, wow, this is fantastic. We've gotten such great returns by investing in Japan. And the answer is, hold on a minute, because it took place during a time period when the yen fell from roughly 102 to the dollar to around, 140, 150, 160 to the dollar. So what happened was The increase in the Nikkei was up a huge amount, but once you adjusted for currency, your return in dollars was very unimpressive, depending on the time period you were looking at. And you think, wait a minute, how can an index go up 50% and I don't make money? The answer is because the yen fell by almost that amount, actually at times more than that amount, against the dollar. So the amount of dollars that you got for that increase in yen denominated Japanese stocks was negligible. It was very small. And a lot of people didn't realize that. So you have this risk. What do you do about it? You can either just take the currency risk and accept that these currencies will fluctuate, or you can try to hedge it. Now, hedging it would involve shorting that country's currency, the foreign country that you're investing in, through futures or shorting that country's bonds. But remember something, one, that's complicated. For something like that, you're going to need a prime brokerage account. These are things that are more difficult to do in like an E-Trade account or a Robinhood account or Schwab, something. It's not impossible, but it's more complicated. There's also an expense to it, and there's risk to it. We've seen situations where people have done that in Japan, and what happens? The Bank of Japan changes their rate, and all of a sudden, we've seen a massive increase in the 10-year rate on Japanese government bonds, right? And that market, by the way, is very thinly traded. It doesn't take a lot to move those bond positions. So there's risk either way. And I'm not saying don't take it. We're saying that the hedge can be expensive or cost you money. But if you're going to be investing internationally and you're doing something more sophisticated like that, these are the kinds of things you need to think about and potentially plan for, to try to deal with those kinds of issues. Mark, you've invested internationally. What's your experience been?
You bring up great points, and that's where, and for anybody that's read the Wall Street Journal or heard, Bloomberg, CNBC, the carry trade, and that's when you think about what Gary's describing of you short one thing to buy another, that's the carry trade. You're protecting yourself, you're trying to guard against. But if things start to unwind, then you have to unwind the carry trade, and it's not just I'm selling stock or I'm buying something. You are unwinding the whole position, which is going to have many knock-on effects. And one of the things that has always been important is always evaluating the geopolitics, as we've talked so much about today, when you're investing abroad. And I look at generational dynamics. You start looking at where the investment is happening. And in the way that the Fed can try to create those opportunities, and you've probably heard this before, the Fed window or the Fed swap window, which can be opened to give countries or other central banks the ability to get dollars without having to worry about the flux or the adjustment in the currency markets, and try to create a direct line. But this is also where trade becomes so important, because a lot of these, if you look abroad, a large part of trade is in U.S. dollars. So if countries are not able to invest, or I should say export into the U.S., then they can't naturally take in US dollars. So if they can't take in US dollars, well, how are they going to finance their local debt or their US dollar denominated debt? How are they going to stabilize their currency? Because a lot of these currencies are backed by either gold or treasuries or US dollars to try to keep inflation expectations very, not to have a straight peg, but to have some sort of stability there. And if you can't get dollars naturally through trade, you then start to liquidate what is your reserve. And as you bring that reserve lower, the market gets more concerned, and then all of a sudden inflation starts to go up. You start to see these fears. The Turkish lira is at the lowest price it's ever been because of these uncertainties. And that makes Turkey very difficult to invest in, because where is the lira going? Is it going to exist? You look at South America. South America, their currencies have lived and died multiple times in the last 30 years. And it's because of that unknown, that uncertainty. And to Gary's point, when you look at Japan, sure, you may have on a paper done very well, but then when you go to realize that, it's like, oh, that wasn't that great because that's in nominal terms versus what we call real terms. When you bring that and take that inflation or nominal rate away, and that's what you have to guard against. You want to be in those growth countries that are attracting capital that are going to be in line with where you are. And to be fair, have some sort of hard asset. Is it a copper mine? Is it a gold mine? Is it a nickel mine? Is it something that is going to have a tangible value that will transcend what is happening within that country or the global fears in the market? And those are things to consider as you're investing, or, and not to get too specific about it, an ADR, which is a locally traded entity on the US stock exchange, but only has access or exposure to a specific region. And those are other opportunities as well. If you don't want to try to get into the hedging and the ISDAs and the prime brokers, because that is a huge cost that can also impact returns.
Yeah, that's expensive. And for people who aren't dealing with financial issues every day, when Mark's talking about an ADR, that stands for American Depository Receipt, it's simply a way of investing in a US brokerage account in assets that are overseas. It's a lot more simple than the terminology makes it seem. Anyway, Mark, always great talking with you. I love our conversations. We need to have you on more often. Hopefully, you'll be a guest host more frequently. I'd love that. For people who are interested in your point of view and from benefiting from your energy expertise, how can they find you?
Sure. So my Twitter is, or X now,
X.
at Mark FNY. You can find me on my at my email of mrossano, Rossano at c6capitalholdings.com, or you can find me on LinkedIn under my name. Keep it very simple.
All right. Well, we'll put a link to you or C6 in the description of this. And just to wrap things up, sorry you didn't have Rob Farian here today. Again, he's on vacation, but really excited to have Mark Rossano guest hosting from C6 Capital. For our interns, great writing this week. Always interested in their view on things, and they're, as usual, doing a fantastic job. And for those of you who are watching this, we know your time is valuable. Thank you so much for spending it with us. We really appreciate it. If you want to give this video a like or want to subscribe to the channel, we'd really appreciate it. It would help us out. But hey, do what you want. We're not the boss of you. Looking forward to seeing you next week.